Welcome back to this video, and in this video we are going to talk about two returns. One is your net return and second one is your gross return. So basically both the returns are used to judge the skills of investment managers. But as you can see from the thumbnail that gross return is a better measure to judge or to compare the skills of investment managers. Why so we'll understand by the end of this video. But before that, we need to understand the concepts or terms used in this particular video. So I'll be talking about a little bit about some clarifications so that there is no doubt because some people might be having some doubts with similar terms in the finance. Secondly, we'll also understand what exactly is gross return. We'll also understand what exactly is net return. And we need to know the formula of both, because without knowing the formula, we'll not be able to appreciate what exactly gross return mean and what exactly net return mean. Okay? And once you have understood the terms and the concept of both the gross return and net return, then you'll be able to tell why net return is the misleading measure to judge the skill of an investment manager. Or in other words, why gross return is a better measure. Okay? So let's begin our video. So the clarification I was talking about is basically, since we're talking about these two terms, gross return and net return, there are similar terms which are there in the financial terms, right? So you must have heard about gross profit and net profit, right? So I don't want you to get confused with those. So if you've heard about income statement, you must have heard about income statement, okay? Or even if you have not heard about income statement, it's perfectly fine. So in income statement, just hold on, alright? I'll just tell you. So in the income statement, when a company earns, right, they get revenue. So it is their earning. And if you deduct cost of goods sold from their entire earning for the year, basically cost of goods sold is the raw material used. If you deduct, you get something called gross profit. Alright. So once you get this gross profit, if I deduct operating expense from this, I get something called operating profit. Okay? From this operating profit, if I deduct, if the firm has taken loan and all, if I deduct interest, I get something called earning before tax. And if I deduct tax, at last, I get something called net profit. So basically, this is the income statement, and what I want to clarify is that I don't want you guys to get confused with this net profit and net profit and gross profit. So basically the topic which we are talking about is gross return and net return, right? So this gross return is not the same as this gross profit, and this net return is not the same as this net profit. Okay. So the terms which we are using in this topic is completely different from the income statement or the terms which are there in the income statement. So just in case if these terms happen to cross in your mind, just forget about the income statement. Okay. So the terms which we are using here, gross return and net return, as I said at the start of the video, these are basically used to measure the skill of an investment manager. So basically an investment manager or an investment firm, what they do is just like mutual funds, right? There are experts sitting there. So they invest in different securities market and they generate revenue for the people who put funds in their funds basically. So how do you compare different mutual funds? How do you compare different investment manager? Is by using this two: gross return and net return. I hope at least till this point everything is clear. So let's talk about gross return. Okay. So basically say when a firm invests, they get a return, right? They'll be generating profit after a while. So they will be generating return. So from this return, I want to know gross return, which is the first term which we have seen, right? And this is the better measure to compare different investment managers, right? So how do I basically get how do I get gross return from this particular return? So as I said before, when a company generates return, this return, and if I deduct two things, first one is trading expense. So out of all the revenue that the firm or the investment manager has generated, if I deduct trading expense and also if I deduct commission fee, then I will get gross return. So let me repeat that again. This is the formula, exact formula. When a firm earns a return and if I deduct trading expense and commission fee from its entire earning, then we get gross return. Okay. So what exactly is this trading expense and what exactly is this commission fee? So as you can see in the video, I put in the picture. So when an investment firm, where do they basically put money, right? So they put all their investment in something called stock market. So in this case, as you see, NASDAQ, it is the stock market of US. And Hong Kong, similarly, there are stock markets like Hong Kong stock market, right? So these stock markets, so basically these stock market, when an investment manager buys or sells investment, could be bonds, could be shares, could be anything. So when they do these transactions, there are some trading fees involved. Okay. And these trading fees are basically paid to this stock market. Alright. So basically that exactly is the trading expense. What about commission fee? So stock market, I think you all are aware about and it is pretty much clear. But you must have seen when an individual wants to buy from these stock markets, could be NASDAQ and could be Hong Kong stock market, or could be anything. So when they want to, this stock market is basically like a marketplace. It's just a market. But if you want to go and buy shares or anything from this stock market, you need brokers, right? So brokers, as you can see from the picture that I've put in, you must be using these brokers. Basically, these are brokers, right? So since we are in the digital age, we have these brokers as an app. So Robinhood, Fidelity, Swap, Webbull, alright. So these are basically brokers. You can sit at home, relax, and then you can invest money, right? Momo, Futu, right? So these brokers, they also take some fee when you invest. Or even if these investment managers, if they are using these kinds of app, they'll pay basically money to these brokers. So those fee are basically your commission fee. Okay. So these two expenses are mandatory, and when you deduct these two, you get gross return. Hope till this point everything is clear. So basically, commission fee for a particular broker and for a particular uh, investment instrument. There are many shares and many different kinds of investment instruments. Like in depth also, depth market also, you have like short term, long term, medium term. And in the share market, there are equities like large cap, mid cap, and then small cap. So all of these investment instruments will have different, how do I say, different trading expense and commission fee. Okay. But if they belong to that particular segment of investment instrument, say for example, if it is a bond, then all the bonds are going to have similar trading expense and similar commission fee. So it is pretty much structured is what I want to tell you guys. So there are lots of shares, right? All the shares are not going to have different trading expense or different commission fee. So basically all the shares out there will have same trading expense and same commission fee. Okay. And it also depends on how much bulk you are buying and all. That also depends because as an individual, you will not have that kind of a capacity to negotiate the commission fee and all. But nonetheless, what I want to say is that trading expense and the commission fee is very much structured and they are same for a particular segment or a particular sector. Okay. Hope till this point everything is clear. So you got this gross return. Now I want to talk about net return. So net return will basically be, so basically your gross return is there. From gross return, if you deduct management fees, and also if you deduct administrative cost, okay, and say for example like custodian fees, okay, and say taxes. So once you deduct all this, let me repeat that again. So from the gross return which we have gotten here, if you deduct management fees and also if you deduct administrative cost, custodian fees and taxes, you will get net return. Okay. And what does all of this mean? That's something we need to talk about. Okay. So let me repeat again. From the gross return, if you deduct management fee, administrative cost, custodian fee, and taxes, you will get net return. So first, management fee. Management fee is basically when a firm, an investment firm, they must be hiring and employing a lot of investment managers, right? So these investors or investment managers who must be handling portfolios and all that, these are experts. So they need to be paid salary, right? Based on their performance or whatever. So that fee is this one. Administrative cost is basically your back-end office cost to run the firm and all. So that is the administrative cost. Custodian fee is basically this fee that you pay to your bank and then financial institution to be the custodian for the assets that you are holding. Basically, they protect your funds and all. And lastly, the tax that you need to pay as per your country. Okay. So once you deduct all this, you get net return, and this is the ultimate true return which is really available to the firm for distribution to the shareholders or to whoever has put in the money. Okay. So once you deduct this, you get this net return. I hope all of these terms are pretty much clear. Management fee is the one which you pay to the investors which are hired by you, hired by the firm. Administrative is for the office cost, custodian is to the bank, and all taxes is the tax. You know what tax is. So hence there might be some other cost involved as well, but these are the major costs. So coming back to the topic, if we see both the formula, why do we say that gross return is the better measure for managing or for judging the skills of the investment manager? This is because net return is misleading, because this management fee, imagine there are several firms, could be big firms, big investment firms, could be small investment firm, could be anything. So the management fee for various or different firms will vary a lot. It will vary a lot. Okay. Some big firms might be paying good amount of management fee. Some small firms might be paying small amount of management fee, or also in the same size of firms throughout, they might be paying different management fee. So this could vary a lot. This management fee could vary a lot. Okay. What about administrative cost? Same, right? If you are setting up your office at a costly place, your administrative costs will be high compared to your office at a cheaper place. And provided that you get good employees there, right? So this administrative cost is also going to vary a lot between companies to companies. That is your investment firms to investment firms. Custodian fee. This is bank. This could be kind of, it might vary, it might not vary. It depends on which bank or which financial institution you are tied up with. And taxes, you know that it varies a lot from country to country, right? So since these management fee and then administrative cost varies a lot from firms to firms, this net return is not going to show the true picture, because as if I say, for example, in firm A, okay, there are investment managers who are very, very good, okay, good or best investment manager. And since they are doing their best, but the problem with firm A is that they have high management fee and also high administrative cost. So since these two costs are high, the ultimate net return will be low. So will you on that basis say that these investment managers are bad? You won't say, right? You'll not say, because they are the expert and they are doing their best. And just because when we are calculating the net return, and just because the management fee, the fee they are taking, or the administrative cost, the office cost, if these two are pretty high, we cannot say that, even if the net return is coming very less, we cannot say that just because these two are high, we cannot say that the investment managers of firm A are poor. We cannot say that. Right? So to mitigate this, we ideally use gross return as a measure to compare investment managers within a firm and also across different firms. Okay? We use which one? Gross return, because these trading expense is same for all the investment managers across all the firms if they are residing in the same country. This commission fee is also almost the same. So gross return is a better measure to truly judge or compare the skill of investment manager. Hope you have enjoyed this video and hope you have liked it so far. And if anything at all that you want to get clarified or get in touch with me, just let me know, like comment down below. And then uh, I want to tell you that I'm also giving exam for the CFA. It might take time, but I am kind of preparing with you guys and hope my video helps you out. And yeah, any feedback from your side, I'm open to it. Thank you guys. See you in the next video.